All right, we're going to go ahead and get started and feel free to, unmute at any time. I'm going to make this really interactive since we've got a small group today. I know a lot of people couldn't come live, but are going to be looking forward to the recording. We have a ton of content to cover. So I am going to just jump right in here and we'll go through a quick agenda. I'm sure you guys probably know me from either the Money Girl podcast or maybe one of my books. I'm Laura Adams. Maybe you're a part of the Money Stack newsletter. However, you found me and however you're here, welcome. I'm super glad to have you. Really glad to be sharing this time with you. I always love live events. I think it's really special when we can get together and answer questions. And think it just gives us a little bit more of an opportunity to learn, especially learning from each other. And if I can share one or two tips for you today that you take away and put into action, I will consider this a success. So whether you're here live or going to review the replay, thank you for coming. And again, all the replays are always free for paid members of the Money Stack, but we always offer the courses separately in case you don't want to subscribe. So, but just want to let people know if you are a subscriber, it tends to be a little bit of a better value for you. So just keep that in mind if you're interested in coming to more, live events in the future. And we have a lot of questions that were submitted ahead of time. So we're going to cover those at the end. And if you have any questions that come up, we'll save those for the end as well. But we're going to get to as many as we can. Also, I'm always very interested in any of the other workshop interests, topics of interest that you may have. Investing seems to be, the most popular one, and that's great. But if there are other things that are of interest, please let me know. See, I saw somebody else joining. Welcome if you're just coming in. We're just getting started. So we're going to go over a quick agenda here. Basically, the workshop is pretty straightforward today. We're going to talk about the roots of investing fear and procrastination. We'll talk about investing myths that can hold you back. We'll talk about managing emotions as an investor. And I'll offer some strategies for overcoming investing fear, some things that have worked for me and I've seen work for other people, and I think could be the ticket to kind of getting over the hump if you're feeling a little stuck. So we'll talk about using very uncomplicated investments to build wealth. And we'll talk about some of my investing mistakes to avoid and Q&As at the end. So let's get right in. I mean, my goal today is just to help you basically acknowledge any fears or any issues that are holding you back and eliminate those barriers that are keeping you either from getting started in building wealth or from, let's say, taking it to the next level, building more wealth than you thought that you could. And I hope to motivate you to either begin or increase your investing efforts for maximum results. And definitely encourage you to ask questions because I think that's where we tend to get the clarity, the confidence, the conviction to set and achieve some realistic financial goals. In a lot of cases, I find it could be just one or two small questions that you have that are really just holding you back. So, if we can get to those questions and get to those answers today, and hopefully that will move you forward. That is a huge goal of mine for today. Okay, so let's talk about the roots of investing fear and procrastination. And I've broken these down into several sort of big categories. The first is practical and knowledge-based factors. So one is certainly a lack of financial literacy. I think, if you don't really understand how investing works, you don't understand different options, all of that, and not understanding risk management, that can definitely lead to fear. And so that's what I hope to kind of bring to you through the podcast, the books that I create, the Money Stack newsletter. All of that is really kind of my mission to improve financial literacy. I think there is a perceived complexity about investing. Unfortunately, I think the investing world can seem overly complicated with lots of financial products, lots of strategies, lots of advisors, lots of things that are, you know, can make it seem very, very complicated. And unfortunately, that can hold people back. And so I really hate that when I see people trying to make investing very complicated. What they do is they just hold people back from getting started. So this is something that I want to make you realize that there is a benefit in some cases to certain advisors or companies trying to make it very complex because it kind of makes them put in a position of power and you feel powerless. And I think that that complexity is just it's false. It shouldn't be there. So that is definitely something that we can get over. We can definitely get through that perceived complexity. I used to have a very complex method of investing, and I can tell you over time it is completely simplified. I mean, I have a very, very simple method, and I'll show you what I do. And I have learned that while you might think that the complex way is going to be more profitable, in most cases, it's not. And in most cases, making investing more complicated actually causes you to lose money. And we'll talk more about that. We also have a lack of confidence. I think this is, again, just believing that you can't make good investments, especially if you don't have the knowledge, that can definitely be a cause of fear and procrastination. Another one is a belief that you don't have enough money. Okay, so this is huge. I see people saying, well, I'm just gonna wait until, I get that promotion or I get that better job or maybe I get some inheritance, whatever it is. Thinking that you don't have enough money to get started is a false belief. You can start investing with very small amounts. It is really something that is for everybody, not just for those with a lot of resources. Fear of being scammed. This is another one that I've seen a lot lately. Maybe, we have had our fair share of scams in the financial world, but I do think it can create general distrust and a fear of being taken advantage of. And I will kind of show you how I invest. And if you sort of go through mainstream channels, you really eliminate the ability of getting scammed. And if you use some common sense, not giving money to people you don't know, not giving money to people who are trying to sell you something, this is going to pretty much eliminate that potential of being scammed, losing money to a thief or a cyber criminal. And a time commitment. I think the perceived time commitment, a lot of folks think I need to research companies. I need to be like constantly looking at investments. People are busy. We don't have the time to do that. So that's another issue that can really hold people back. Okay, another big category that I think can cause investing fear and procrastination is psychological. It is the emotional and psychological factors. So something called the fear of loss, which is called loss aversion. And so this is the idea that the pain of losing something is felt much more intensely than the pleasure of gaining something of equal value. So we fear losing money in an investment much more than we get excited about the ability to gain money and to have profit in an investment. We also see that having a feeling of uncertainty or lack of control, maybe it's because you're seeing volatility in the stock market. Maybe you are seeing, just unpredictable things going on in the marketplace. That uncertainty can certainly be cause the fear of investing or procrastinate investing. And I do acknowledge that it can feel very unsettling for many people. But I'm going to give you some strategies and tools to deal with that uncertainty, because we can't eliminate it completely. Fear of the unknown. I think, again, just if you're new to investing, the jargon, the different investment vehicles, the different accounts, just all the account dynamics and market dynamics, that fear of the unknown can keep you from investing. Past negative experiences. Maybe you invested in something in the past and lost money. Maybe you had a really bad experience. And if that happened to you, I'm definitely sorry that that happened. And that, bad experience in the past, whether it's with a bad advisor or just making a bad decision, that can definitely create a barrier to moving forward. The fear of making mistakes. Again, just the fear of, I'm going to choose the wrong investment or I'm going to use the wrong account. This is very, very common. And again, I'm going to give you some strategies to make sure that, we can't eliminate risk completely in investing, but we can reduce it significantly. And we'll talk more about that. An emotional attachment to money. None of us want to lose money. None of us like the idea of putting our money at risk. But that is inherently a part of investing. So we need to really understand that if you want to keep money 100% safe, it should not be invested. If you want to keep money 100% safe, it should be in a savings account with FDIC insurance. That is really the only way to protect your money. But the problem is, even when we do that, we're actually likely losing money over the long term because we're losing money to inflation. The inflation rate is higher than what we're earning on our savings in a lot of cases. Or maybe if it's about the same, we're just staying even. So this is why investing is so, so important. We do have to put our money at risk, but we can control the amount of risk. We get to choose that. All right, a third bucket of fear and procrastination are external factors. So a big one is the media. We just see a lot of market coverage about downturns. Right now, we're hearing a lot about potential recessions, even potential scandals that are out there. All of this can create a negative perception of investing in general. Other people, maybe you have family or friends who have had bad investing experiences. Maybe they're discouraging you, or maybe just their bad experience is kind of rubbing off on you, and you're feeling like, wow, seeing what happened to them is making me feel fearful or just not wanting to get started. Or social pressure and comparison, even hearing about other people's great successes, people who say, oh my gosh, I've made so much money from this investment, or I'm doing so well. I mean, that can lead to a lot of comparison and anxiety, thinking that you're not going to be able to keep up, or not going to be able to make as good a investing move as somebody else. So all of these external factors, really need to be ignored. They're, I think, a lot more easy to ignore. They're easier to ignore than the psychological factors, because some of those can be just so deeply ingrained in us. But I want to just acknowledge that we all have some component of these fears in our lives. Some of them may be smaller than others. Some may struggle a lot with these different fears. So I'm curious, of the fears that I've listed here. I'm going to stop sharing and just for a moment here see if you guys are interested in just sharing if there's anything else that you can think of that I didn't mention. Is there a fear here that you have, or something holding you back that I didn't mention that you think we should acknowledge and talk about? So feel free to come off the mic. Feel free to put something in the chat, whatever you're comfortable. You can come on video if you'd like. I'd really love to make this interactive. If you have something to add here, or really feel like, I missed something.
Hi,
Hey, how are
I'm
you?
I'm nice to meet you, Laura. It's such a
Yes.
pleasure. One thing, because I just did my taxes for last year, and I guess one fear that I have, because I like started a brokerage account with Vanguard last year, and I have like, just very small amount of money there, barely made anything, but I had to like put it on my taxes. So I'm like, oh wow, if there's more money there, it's gonna get taxed. So now I'm thinking like that's a fear I didn't expect. I'm like, I'm gonna be overcomplicating my taxes, or I guess there's like that fear of like a new thing to think about.
Yeah, that's terrific. That's fantastic. And I do think a lot of people don't expect that. That's kind of a downside, right? You make money, which is wonderful, but yes, it's taxed. Well, Marcella, I'll give you some ideas about ways. We'll talk about this. We'll talk about some ways to make investments where you're not going to have to deal with any taxes because they are tax deferred. Or even tax free. And so that's really a good way to simplify. So if you're afraid of the taxation on making money from investments, you can definitely avoid it. In fact, I would recommend that. I think that's a really great way to set yourself up. Now, you can also invest in taxable accounts as well. There's nothing wrong with that, but I always encourage people to maximize the tax deferred, the tax advantage options first. So that's awesome. We'll talk more about that. Anything else? All right. Well, we'll go back to our presentation then, and just kind of continue along here. All right. So, thinking about these different buckets of procrastination or buckets of fear, reasons we might be fearing and procrastinating, I do want to cover some myths that I think are super common that I hear over and over that are holding people back. So, I mentioned this one. I don't have enough to invest. Okay. Many people believe they need a lot of money to start investing. And the reality is, you can start with very, very small amounts. Most investing platforms these days literally let you open an account with $5. You can, invest literally $1 a month if you wanted to. Certainly, I'm going to encourage you to invest more, but you don't need much to open. You don't need much to invest. There is no requirement that once you open an investing account that you have to do anything with it. So you can get started and invest as you feel ready to do it. Now, I'm going to encourage you to set up a routine, a regular schedule, but that doesn't have to be what you do. I think small regular contributions are best because due to compounding, they really allow your balance to grow over time. So I would say don't think about investing a large amount. Think about, what can I invest regularly? What can I invest either weekly or monthly that I could realistically keep up with? Is it $5 a month? Is it 500 a month? Whatever it is and whatever it fits in, however it fits in your budget, that continuity is really what's best. Another myth is investing is only for the rich. I think I hear this a lot. Oh gosh, this is only for wealthy individuals. And the problem with this is that, we all need to provide for our financial futures. The reality is that everyone can invest no matter your income level. Yes, there are investment firms that will literally only work with somebody if they have $1 million to invest. They're out there. Those firms exist. And yes, they're providing services at a very high level, but there are investment options and strategies that are suitable for everybody's situation and goals. Past performance guarantees future returns. So this is a myth, I think, that we need to understand that just because an investment did well in the past doesn't necessarily mean it's going to do well in the future. And so I see a lot of people saying, "Oh my gosh, Nvidia, this stock, it's done so well, so this is something that I need to buy. I need to get in on." And the problem is that past performance is not a reliable indicator. Market conditions can change, company performance can change, and this is why diversification is so critical. And when I say diversification, what I mean is owning a little bit of a lot of different investments. And so there are funds we'll talk about that you can purchase that have this built in. It's just inherently baked in that they own hundreds or thousands of underlying investments. So basically you own one investment, but inside it are literally hundreds or thousands of stocks. So that's so important because let's say Nvidia crashes, you're going to have hundreds of other stocks and underlying investments that are going to go up. The market conditions are going to affect companies in different ways. So maybe the tech sector is suffering, but maybe the real estate sector is doing well and going up. So the idea is that there's constantly rebalancing going on, and that helps you maintain what looks more like broad market exposure. You're going to have investments that will do better when the overall market is doing better. So when I say the overall market, like the S&P 500, like an entire market that's made up of thousands of stocks, when that is going up, your investments are going to do better. And we'll talk a little bit more about that. Another myth is I need to be an expert. No, unfortunately, you don't. I think a lot of people want you to think that you need to be an expert to invest. But you don't. The reality is that with some basic financial literacy and concepts, you can easily use online resources, online platforms. You can work with an advisor if you want to, and I certainly recommend people do that when they have maybe a complex situation or they're nearing retirement. But for the vast majority of people, we have a lot of really great options online, and I'll share with you mine. Investing is too risky. Well, I think we often overestimate the risks. And people say, oh, well, it's like gambling. The reality is, if you are investing with an intent and you have a kind of a mainstream investment where you understand the level of risk, it's not gambling. And as I mentioned, you do have to put money at some level of risk in order to make it grow. So if you are strategically investing by diversifying, you're investing regularly, that is a strategy. And so, in my opinion, not investing is riskier than investing in the long run, because oftentimes people who are not investing are keeping their money just sitting in a savings account. And yes, it's very safe, but that often means you're earning very little. You're earning, a fraction of what you could, and you're likely earning less than the inflation rate. So that money that's just sitting in savings, it's slowly being eaten away. Its value will not be on par with inflation in 10, 20, 30 years. So yes, all investments do carry some risk, but with diversification and having a long-term perspective, that absolutely can help mitigate risk. I can time the market. So this is when people think, oh, well, I'm going to buy Nvidia because I think it's going to go up, thinking that I can sort of predict what's going to happen. I can predict the highs and lows of a market or a company. This is a big misconception, because it is literally impossible to consistently time the market. I mean, even professional money managers that do this for a living have less than a 50% chance. They tend to, and oftentimes if they're not an extreme expert in an area, they're making a lot of trades that end up costing money in the long run. The more you're trading and going in and out of the market, the more fees and transaction costs come with that. So I really want to encourage a strategy called dollar cost averaging, DCA. And dollar cost averaging simply means that you pick an amount that you can invest on a regular basis, whether it's monthly, weekly, and invest the same amount, whether it's $5, whether it's $500, picking that amount and investing it regularly. And when share prices are down, you're going to end up buying more shares. When share prices are higher, you're going to buy less. But over time, that fluctuation, the ups and the downs, will smooth themselves out. And so that's why it's averaging. You're buying at a cost that averages over time. And so that has actually been proven to be much more profitable over the long run than trying to time the market by saying, okay, looks like the share price is down this week. I'm going to buy in and I'm going to get out next week. That can work in some cases, and maybe it can work if you have money to play with. But if you're talking about money that you really can't afford to lose, money that you truly need for the future, dollar cost averaging is going to be much, much more successful in the long run. Okay, I should only invest in individual stocks. So this is definitely not something that I recommend. Again, it's if you've got money to play with, maybe investing a little bit in individual stocks could work for you. But in general, that is not how successful investors build wealth. They're going to own many, many stocks through buying funds that are either called index funds or maybe a stock fund that is comprised of many, many individual stocks. And when I say many, again, I'm talking about hundreds or thousands of underlying stocks. That is what I'm going to recommend. So trying to pick can be super risky, very time consuming as well for the average investor. But if you're somebody that enjoys researching companies and stocks, maybe set aside a small percentage of your portfolio that you might devote to doing that, or even trading on paper first before you actually buy, use real money to make investments. That's another way that you can kind of exercise your analytical skills and see, well, if I had invested $100 in this stock, what would it be worth today? You can kind of do a little what we call paper trading. That's one way to see if buying individual stocks is right for you or not. So again, I'm going to recommend diversifying investments using mutual funds or exchange traded funds. This is much less risky and something that is recommended for a long-term growth approach. Saving is the same as investing. This is definitely a myth. As I mentioned, while saving is important for short-term goals, it is not going to get you where you need to be for your longer term goals, like retirement. Maybe even a longer term goal, like buying a home in, let's say, 5 or 7 years down the road. You would want to invest for any goals that are about 3 to 5 years into the future. But if you have a goal that's just a couple years away, maybe you want to buy a car next year, I would not recommend investing that money. So think about investing as specifically for those long-term goals. Saving is for your short-term goals. Myth nine, you have to buy and sell often to make money. So again, the trading of individual stocks, it really can cause you to lose money. Every time you buy and sell investments, there is a transaction fee for doing that. And that's why it often causes people to lose money. And so a buy and hold strategy where you're buying consistently, that dollar cost averaging, buying on a regular basis and holding it, literally just holding it, owning it for the long term, that is where you're going to find that you're going to profit from what the market is doing. And so the market is going up over time. And so that's where the buy and hold strategy will be much more beneficial for you. You don't have all of those transaction fees of coming in and out of a trade. Okay, and the last myth, now is the wrong time to invest. I think a lot of people are always waiting for the perfect time, saying, oh my gosh, the market it's too high, it's too low, it's too uncertain. There's always an excuse that we can make. And I would say there really is never a perfect time. But the problem is if you try to time the market, when are you going to get back in? When are you going to jump in? If you take money out of the market when prices dip in the short term, are you going to want to get back in the market when prices go up and you feel like you're buying at high prices? That's not a good way to make money. We want to be buying low and selling high, but you can't predict that. So that is why this constant dollar cost averaging, just the consistency, is going to not only be mathematically a better way to make money, but I think psychologically, today we're talking about fear, we're talking about procrastination. And I will say having a strategy where you say, I am going to buy in a certain amount on, the first of the month or the 15th of the month, that can really take a lot of stress out of I think your investor psychology. And whatever's going on in the market, whatever's going on in the economy, it doesn't matter because you're going to be buying in. Your goal is to have those investments increase over the long term, like 5, 10, 15, 20, 30 years into the future. So you're concerned with the long term results, not what the market is doing today or tomorrow or even next month. So, how do we manage emotions as an investor? I think there are some key ways. Definitely ignoring the investing media. If you're watching any investing shows, don't watch them. I just think it's terrible trying to give people, quote, hot tips or, unproven advice. They're trying to make money on these shows by, keeping you roped in and by showing you advertising. They're really not looking out for your best interest. So the investing media is just there to hype you up, and investors do not need hype. We want to take investing action, even very small moves. I think just getting started in a lot of cases can alleviate anxiety. And what's the saying? Once begun is half done. Once you've begun something, it's almost like you've almost completed the task because that motivation to begin is what's so difficult. So if you haven't begun investing and you haven't taken any action, even some very small moves can counteract your anxiety. So whether that's opening an account or signing up for a retirement account at work, whatever small move you need to make just to move the ball forward, that investing action can definitely alleviate fear and help you take control of your emotions. Involving somebody else. So, make it a team effort. If you're worried about money, you're worried about investing, talk about it with somebody, maybe with a friend who's also in the same sort of stage of life that you are. And, just talking with them about their investing. I think involving somebody else can be really helpful as an investor if you are feeling fearful. And just starting slow, knowing that you don't need to invest a whole lot in the beginning. You can start with very small amounts and kind of ramp it up over time. Just starting slow, sort of dipping your toes in. That's a great way to just gradually feel more confident as an investor. And having a plan. So when I say a plan, really what I mean is having a dollar cost averaging plan. So what can I afford each month? Setting that amount and kind of sticking to that. And then at the end of the year, maybe you reevaluate, see if you can increase that and raise that investing or savings rate just a little bit each year. And automating. Okay. So this is another, I think, real trick to improving your psychology as an investor and managing emotions. This is why the 401k at the office is so successful. It has to be automated. It can only come from your paycheck. So those deductions have to come through your employer. And that automation just makes you able to kind of tune it out. It's happening in the background. And you can implement that in your own investing. You can set that type of recurring automation up if you have a brokerage account, a taxable brokerage account, or even an IRA. If you don't have a retirement account at work, or maybe you're self-employed and you've got a self-employed retirement plan, you can create that automation on your own. So again, you're setting up that dollar cost averaging. You can kind of tune it out. Okay, so I've talked a lot about DCA, the dollar cost averaging. I just want to review here. It reduces risk. So you're buying more when prices are low and less when they're high. That is cutting risk over time. You avoid trying to time the market. Nobody knows what prices are going to be in the future, but we do know a general market history. We do know what has happened, and I'll talk a little bit more about that. But for example, the S&P 500, that market has done extremely well over time. We've had about a 10% return over time. So if we're mimicking the market, we know that we can expect at least something similar to that over time instead of trying to get in and out of the market, buying low, selling high. That typically doesn't work out. And I think dollar cost averaging, it's very emotionally comforting. I think it can reduce a lot of anxiety related to volatility because you're not going to be looking at volatility. You're not going to be looking at prices. All you are doing is saying, on this date, I'm going to be investing this amount. And that should help you kind of tune out any of those media, the media hype and the things that you're hearing about the market. I think DCA is also great because it works for everybody, whether you have a little bit to invest or you've got a lot to invest or you're experienced or inexperienced, it works for everyone. And just a quick here, Morningstar has done a lot of studies about buy and hold strategies versus trying to time the market. And they found that buy and hold strategy earns 10% or earn 10% more than market timing. I think this was a study that they did for 2021. And the quote here from them is dollar cost averaging is one of the best financial tools that a person can use because it takes human error out of investing. Instead of feeling like you have the ability, which we don't, to time the market, it gives you the best opportunity to get the best cost for your investment. So again, there's a mathematical reason why dollar cost averaging works, but also a psychological benefit. And I think it also reduces a lot of stress when you have a plan, you know what you need to do to get the results that you want. So here is a chart that shows what you can expect with very small contributions. We talk a lot about you don't need to have a lot of income to be an investor. And so this chart just shows what you could expect if you invested $200 a month with a 7% average return. 7% is very doable. And over time, if you are looking at the blue, which is your investments, and you're starting here at age 25 and you are going up to age 70. So over your career, you're investing the same amount. You're investing 200 a month with this average return. What you could expect is a portfolio value of 1.1 million over those all of those years, those 45 years. And this is with a 7% average return. I think we could probably do a little bit better than that, but just showing that with a conservative return, a reasonable return, and a pretty, I'd say, not a huge amount of investment. You're looking at a contribution over your career here of $120,000 contributed, just chipping away $200 a month, and being able to come out the other side with 1.1 million. It's a pretty good scenario and a very realistic scenario as well. And so here's another chart showing that if you are looking at putting in a little bit more, you're investing here $450 a month with the same return, 7% return. So you're contributing over your career, 270,000. The power of compounding interest gets really, really impressive, like, around age 40, 45, or in the 40th year or 45th year, you see compounding interest really kick in. And what happens is in those later years, your portfolio value is almost doubling. And so what you end up with is a very impressive portfolio value that is close to 2.5 million or at 2.5 million. So again, this shows investing a little bit more. Instead of 200 a month, we're investing 450 a month. But just the power of that small consistent contribution over a very long period. And if you are thinking, well, Laura, I'm not 20 or I'm not 25, I haven't started that early. That's okay. The power of compounding interest still applies. If you've got time to go before you need to spend the money, you have time for compounding interest to work in your advantage. But you do need to maybe contribute more. You may need to kick up those contributions in order to kickstart the growth that you need to reach the goal that you want. So, what I am a fan of is using very, very uncomplicated investments to build wealth. And so, index fund investing is something that I always recommend. And an index is very simple. It is simply a fund that tracks a market like the S&P. You'll also hear the Russell 2000 by basically owning shares of all of the companies that are in that index. And I love it not only because it's very minimalist, but it's a low cost way to diversify your portfolio and get higher returns. And so when we're talking about index funds, they can be mutual funds, they can be exchange traded funds. The bottom line is that it is a fund that is trying to mimic or track a market index. And the reason that's so important is because it's going to be less volatile. As I kind of mentioned, when market factors change, you're going to be able to benefit from some of the stocks going up. Some are going to be going down. And so over time, you find an average there. Basically, it's the opposite of active investing or stock picking. So it's much, much less volatile. As again, they often outperform actively managed funds. So the funds that try to buy and sell and kind of time the market often don't do as well because they are subject to tons and tons of transaction fees and just human error as well. So per Morningstar, in the first half of 2024, 81.8% of actively managed funds failed to outperform the S&P 500 index. So to me, that just shows that there's really no use trying. Nobody can predict the market. So let's make it easy. Let's make an index fund the way to do it. And they'll go back in time and say, okay, well, if I had a actively managed fund, would I have done better? And even going back a decade, Morningstar said, nope, nearly 73% of actively managed funds fail to outperform the S&P 500. All right. So just to show you the kind of the index here, what I'm talking about, if you go back 100 years and even adjust for inflation, looking at the performance of the S&P, what you'll see is that yes, it's gone down in certain years, it's gone up and gone down, but over time, we're seeing a really impressive up and to the right trend. And that's what we're looking for as investors. And the annualized return has been 10.6%. And again, adjusting for inflation, kind of, backing that inflation rate out, you're still getting a 7.4% return. So that's over the past 100 years. Even if you look 20 years, we go back and say, well, let's just see what's happened the past 20 years. The annualized return has still been very impressive at 9.8%. Adjusted for inflation, 7.5%. So this is why kind of hitching your wagon to the S&P 500 index is a really smart plan and an easy plan, especially for anyone who's feeling fearful, maybe like just afraid of how to get into the market safely. Now, if you're somebody that wants to take a lot of risk, or you have money that you're okay putting at higher levels of risk, there are other options for you too. But for the vast majority of investors out there, indexing is the way to go. So I wanted to share with you my investing portfolio. If you've been on a workshop with me before, I'm really transparent about what I do, and I right now have all of my investing with Betterment. They're an online platform, and I like them, and they're great. And if you want to use them, fantastic. I don't get any benefit from recommending them. There are lots of good online platforms, so they're just one of many good options. But I like them because they make it super simple to choose a strategy, and you can choose your level of risk and adjust it up or down as things in your life change. And so right now I am at 82% stocks, which is pretty aggressive. And so that really comes down to my belief that the markets are going to do well over time. They're going to continue to rise like that S&P 500 chart. And I have, decades to go before I plan on spending that money. So for me, that risk is appropriate and good. Now, for somebody who maybe is, let's say, in retirement, or maybe somebody who doesn't feel as comfortable with risk, you might dial that back, and it might be 60% stocks or 70% stocks, with the balance of your portfolio in bonds and cash. And bonds basically, eliminate the level of risk because you get a guaranteed return. So bonds basically are you lending out your money and getting a guaranteed return in exchange for that. So it could be a bond to a government or even to a private company. It has some risk. I won't say there's no risk there, but it's much less risk than the value of a stock that can go up and can go down. Things can change really quickly with stocks. That's not the case with bonds. So the balance of my portfolio is a combination of bonds and cash. And this is just a look at what Betterment offers. When you go in, they give you portfolios that you can choose. I chose the core portfolio. They recently added the socially responsible investing, which is kind of neat. Innovative technology. They really lean more into tech there. And I think they have a couple more portfolios that they've added recently as well. So, just kind of showing you they kind of make it really easy to just select a portfolio. And then once you select it, you can adjust your level of risk. Betterment was one of the very first investing platforms to do that. I think many have kind of copied what they're doing. So you may find that same level of adjustment and, sort of select portfolios that are already created for you. I'm sure you'll see that in other platforms as well. So, but my point here is it's very easy. It's very easy to get started and maintain and to make adjustments if something in your life changes. So I just wanted to cover a few of my investing mistakes, and then we'll get into questions that are pre-submitted and any questions that you guys have now. I would say my biggest mistake was not starting earlier, and the reason I didn't start earlier was because of fear. I was in my very first job. I remember in my 20s, right out of school, the job offered a 401k, and I did not participate. My reasoning was, well, I'm not going to be in this job forever. Maybe I'm only going to be here a year, maybe 2 years. And I thought, surely they're going to take some portion of my money, or they're not going to let me take all of my growth with me. I simply didn't understand how the 401k worked. Nobody explained it. Nobody made it clear that all of the money that I put in and the money that grew in the account was mine to keep. I didn't understand that. And that's why I didn't start investing until several years later, when I realized, oh wow, there's no risk here. I can roll that money over into an IRA when I leave. I can keep all of it. There might be a vested portion where the company puts in a portion for you that where you do have to be there a certain period of time. So there may be a vesting schedule of, 1 year, 2 year, 3 years. It might just vary depending on your company. Yes, in that case, they may not let you take the funds that are not vested, but that should be a very small portion of your portfolio. The money you put in from your own paycheck, that money that grows is always yours to keep. Another huge mistake is, I think, getting greedy. There was a time where I mentioned I had a very complex and complicated investing outlook, and I did a good bit of day trading. I was really into analyzing companies. I enjoyed kind of making trades and getting in and out. And although I learned a lot doing it, I can tell you it didn't make me any wealthier. I don't think I lost money doing it, but I certainly didn't make the kind of gains that I expected. It was not worth my time. I spent a ton of time investing, or rather, analyzing, researching. And, in hindsight, I certainly learned a lot. I'm glad that I went through that and saw that there's an easier way. And so whenever I see people thinking that they need to invest a ton of time in investing, a lot of it comes down to greed. They feel like, I want to make more. I want to, get these high returns. And in many cases, it just doesn't work out that way. So again, we can't beat the market. And anybody who says they have a system or can help you read charts in order to know when a stock is going to go up or down, they're not telling you the whole truth. The truth is that we can't predict markets. We can't predict what is going to happen. And if you have a little bit of money that you want to play with and you want to day trade, fantastic. Learn, use it, but don't depend on that, and don't let that feeling of wanting higher returns keep you from just creating a really good system that is going to be able to build wealth slowly over time. And then again, trying to time the market, as I've mentioned over and over here, it just doesn't happen. So if we could time the market, everybody would be super wealthy. But it's something that I think is getting more and more difficult to do. Technology is making it more difficult to time the market. It used to be, I think, before we had like super fast trading, people really could understand like what was happening in the dynamics of a company, and do a lot of research and figure out what the future might hold. But with very fast trading these days, knowledge is spread throughout the marketplace so quickly that it's very difficult to have an edge, unless you are a true insider. And if you are an insider, it's illegal to do insider trading. So anyway, for all of those things, I always just come back to a very simple, minimalist approach. All right, so let's go through your submitted questions. We can start here. You guys sent in some great questions, and we'll just cover as many as we can. And I'd love to take live questions as well. Ashley wanted to know, this was a great question, Ashley. What impact do you expect AI developments to have on financial markets and related services? How should early stage professionals adapt their financial strategies to account for industry changes and plan for long-term savings? So AI has already changed financial markets a lot. A lot of the benefits that you get from services like Betterment comes down to AI. It's a lot of machine learning. They've created algorithms so that they are rebalancing your portfolio in a very efficient way. So I think those developments are going to continue. I think we'll see maybe even more tax efficiency with AI. I think that's an area where AI could probably benefit us all a lot. But, the downside is that AI has made it very, as I mentioned, just trading has made it very difficult for the human aspect to beat the machines and AIs when we're talking about kind of getting an edge on the market. But overall, I think I think it's beneficial for us, and I think it's just creating a lot of opportunities to automate, to have good advice, for very, very low cost in most cases. How should early stage professionals adapt? I think, it doesn't change a whole lot for your long-term savings. I do think that it still comes down to a dollar cost averaging approach, diversifying. I don't think AI really is going to change that. I think starting early, investing as much as you can, being just as consistent as possible. I don't, I don't see how that's going to change. I don't think AI will change that. So, Ashley, thank you so much. It's a great question. Okay, Marcella, here's your question. Would it be most beneficial to pay off my student loans sooner than expected, or focus on investing for the future, like saving for a home or retirement? Um, 60,000 in undergrad debt. Yeah, so I am going to say that likely, and do you know what your student loan rate is, or loans rates are right now?
Yes. So the government ones vary between like 3% and 6%. And then I have a private student loan, which was a big mistake. Don't do that. It's at like 9% right now because it's variable. So it used
Mhm.
to be like 4% and it fluctuated and now it's at 9%.
Okay. Yeah. So, those are relatively low rates. Um, and how do you feel about your investing? Do you feel like you're on track? Where are you in terms of retirement savings right now and investing?
I have had the opportunity to do 401k with my jobs. So it's not a lot. I think last time I checked, it was probably around like $70,000 in 401k, maybe a few $1,000s in like a Roth IRA. So it's like not on track for what I feel like 34-year-old person should have. And I feel like I can do a lot better with how much I can invest.
Yeah, so you're not doing bad at all. Don't knock it. That's a great amount to have saved. And if I were you, I would continue with the retirement savings. I would not try to accelerate the student loans. I would just keep them on, paying the minimum amount each month. And I say that because I think you can earn more on your investing than you can by paying off the loan. Yes, you're going to get a guaranteed, let's say, 4% return if you pay off a student loan at 4%. But you have time on your side right now. You're young. You have so much time ahead of you. All of those curves that we look, going up, 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 the more that you can put in right now, that is going to enable you to really take advantage of compounding growth over time. So I would probably rather see you just stick to the payoff schedule that you've got on the loans. And I know that they can feel really aggravating, like you just want to get rid of these things. But don't think about it that way. Think about what's the best use of your money. What is that opportunity cost? If you use it to pay off the loan, you didn't get the opportunity to put it to work and return a higher return over time. So, and if maybe you get a little bit extra, you get some kind of a bonus or something where you feel like you want to go ahead and allocate money toward the loan, great. But I would rather just see you kind of increase your retirement and just kind of slowly inch that up as much as possible. When you look back in 10 or 20 years and you see this massive nest egg, you're going to be way happier with that than just saying, "Oh yeah, I paid off the loan," because the loan is done, it's wonderful, but that retirement account is going to continue growing and building for you. How does that sound?
Yeah, that's exactly where my mind was too, but I wanted to hear it from like a professional who's like knows money because it's like everyone's like pay off your debt, pay off your debt. But it's like some debt is just not bad. This one was an investment for my education, and I feel like I have a really great job from it. So, like, to me, it feels like, okay, I took a risk because, yes, job market and whatnot, but like, I'm betting that it's going to work out no matter
Yeah.
what I do. And that, yeah, like, I'd rather put in actually more money now towards retirement and investing, and then slowly start paying off more and more of my student loans. But like I
Yeah.
think now is yeah, because I've been through like three layoffs in retail, crazy stuff, but I think still investing is like so important.
Yeah, absolutely. So, really looking at those interest rates, just focused on, yep, I'm going to be earning more than I could pay off. And as you said, down the road, when things maybe change a little bit, you may have the opportunity to pay off the debt more quickly. But yeah, that consistency in the retirement investment is just so key. So you're doing great. Don't worry about feeling like you're not where you should be. I don't really think there is any such thing. As long as you're doing what you can and feeling like you're stretching yourself a little bit in terms of your investing, that's where you need to be. A lot of people are not, they're not kind of feeling enough of a pinch. They should be, it should be hurting a little bit. I want you investing so much that it's hurting a little bit. All right, let's see, what else have we got here? You guys sent some terrific questions. Let's see if I can get my screen sharing back.
I see your screen. I don't know if it's just stuck, but I see my question still up there.
Okay. All right. So, the next great question that came in was from Amy, who was really, a little feeling uncertain about tax implications with different investment accounts. And I really understand that. And Marcella mentioned that as well. So, I put in some information here, really thinking about two basic types. You've got tax advantaged and you've got taxable. And we always want to prioritize tax advantage. So when we talk about tax advantage, we're talking about IRAs that could be traditional, and that's a tax deferred retirement account. Basically, the money that you put in isn't taxed. It's going to grow, and then you're going to pay taxes in retirement when you take the money out. You've got Roth, which are also fantastic. These are tax free. You're going to pay tax on the Roth up front, but it grows tax free. You've also got medical savings accounts, which we often forget about, but HSA, the health savings account, and FSA, flexible savings accounts, those are also tax deferred. Now, when you put money into those accounts, you are either deferring or eliminating taxes. And so the problem, that we were talking about with getting income from your investments and then having to pay taxes on them, it doesn't happen because they are sheltered inside these special accounts. So the other type is taxable, and these are fine too. But what I want you to do is prioritize the tax advantage. If you max out a tax advantage, then you can think about going into the taxable. This is a brokerage account, just a regular investing account. What happens there is any earnings, your interest, your dividends, those do get taxed annually at your ordinary tax rate. Now, your gains, when let's say you decide to sell something, you have a fund that you decide to sell and you make a profit, that's called a capital gain. And when you actually sell it, that's when it gets taxed. But if it just goes up in value, you don't pay tax on it. That's just what we call a paper gain. It's only tax when you actually sell it, you actually make a profit. So choosing tax advantaged is just the way to go. So prioritize things like the 401k, 403b, 457, TSP, whatever you have. They've got really great high contribution limits. It's 23,500 or 31,000 if you're over 50 for this year. You might get employer matching. You're going to get payroll deductions, as I mentioned. The Roth account is really nice to have it work because those do not have an income restriction. There is an income restriction if you have a Roth IRA. You might be able to take a loan on a workplace plan, and they also come with federal protections. So let's say if your employer goes out of business or tries to do something malicious with your funds, you have federal protections there. IRAs are what I would recommend next because they have lower contribution limits than workplace plans. It's either 7,000 or 8,000. You do have to have earned income, but a married spouse can actually fully fund a IRA for a non-earning spouse. And again, the traditional IRA is going to be tax deductible, and the Roth IRA is something you do have to pay tax on when you put it in, but you're not going to have any tax after that. It's going to grow tax free. So the problem, though, with the Roth IRAs that high earners cannot contribute. And here are the limits for 2025. If you're single, you basically can't make a contribution when you make over 165,000. If you file as a joint taxpayer, you cannot contribute when your household income is at or above 246,000. So you do have some limits there. Again, that's only on the Roth IRA. So lots of good benefits with the Roth. The bottom line is that when you're in retirement, you're ready to take the funds out, they're tax free. And that is just so nice. Okay, we're going to keep moving on here with submitted questions. Allison said, how does investing fit into the big picture of financial strategy? And so this is great. I mean, she's saying, do I invest alongside my 401k and general savings? And definitely thinking about your goals is the first place, Allison. Figuring out if, the only goal you have is retirement, then maybe you only need to be investing in the 401k. But if you do have other goals, maybe it's buying a home, or maybe it is just investing more. Maybe you maxed out the 401k at work and you want to invest more. And you could use a brokerage account. You could use a taxable account to go ahead and invest. In terms of general savings, I always recommend having a minimum of at least 3 to 6 months worth of your living expenses in a savings account. Savings is not the same as investing. We want to save money for short-term needs like emergencies. So let's say you lose your job or your business income, having at least several months worth of living expenses, that's there just to keep you safe and to reduce stress as well. So savings is for short-term, all the short-term needs, or maybe even you want to buy a car in a year. But investing is going to be for goals that are longer than that, things you want to do like 3 years from now, 5 years from now. So if you do have big picture financial goals other than retirement, maybe if you have kids, it could be investing for their college. These are all the things that you do want to do alongside the 401k. So that's great. I think, the big picture always starts with goals. What are you trying to accomplish with your money? And then kind of working back to make sure you have all your various accounts set up to meet those goals. And again, it really comes down to short, medium, long-term goals. I always say smart investors only take enough risk with their money to achieve their goals. So if you don't need to take a lot of risk, don't do it. If you need money in a year to buy a car, don't put that money at risk. You want to use a savings account for that. If you invested that money, the value could drop next year when you need the money to buy the car. So only taking enough risk to meet your goals. Okay, Lorelei said, how much to invest at 50 years old? Well, Lorelei, this is going to depend on your goals. I think if you are feeling like you're nearing retirement and you've, done well and you've got, you're going into your kind of pre-retirement years feeling like you're in great shape, you may not need to invest much. But if you're somebody who feels like you're behind and you don't have as much as you had hoped that you would at 50, then this is the time to really ramp it up. You have a lot of benefits being over 50. You can actually contribute more to retirement accounts, to an IRA or a workplace plan if you have it. So, in general, how much you should invest at any age really just depends on what your goals are. How much do you need to live the lifestyle that you want? And also thinking about things like, what's your other income? Will you have Social Security to rely on, maybe a pension? All of those things will also help you determine what's that kind of nest egg that you need to sustain your lifestyle. And then from that amount, that nest egg, you can work backwards and figure out, am I on track? How much do I need to invest? Am I ahead or am I behind? So I don't have a whole lot to go on here, but I will say, working with a financial advisor as you sort of get into pre-retirement can be very helpful because they can really help you understand different scenarios. Like, well, what if I took my retirement benefits earlier versus later? Or what if I did different things? What if I took a little bit more risk? Or what if I were a little bit more conservative? They can really put some scenarios together for you to make sure that you're going to be on track to have the lifestyle, that you want going forward. And Alana has a very long question here that I'll go through. But basically, I think the gist of Alana's question is she's really trying to understand what her parents need to be doing to make sure they've got lifetime income. They've got about 3,500 to 4,000 a month in income. They've also got a HELOC balance of 50K that her mom wants to pay off. And she says she's really just trying to help them know what to do, and is wondering if an income annuity could be something that would be beneficial. So, Alana, you definitely have a lot of moving parts here. I would say that they could certainly benefit from working with a financial advisor. And an income annuity might be a good option for them. Basically, what an annuity does is it guarantees a certain amount of income for life. And so you pay an amount up front or pay amounts over time. And you are basically buying a contract with an insurance company. And the insurance company says, okay, we're going to take your money and we're going to invest it for you. But in return, we're going to guarantee you a set amount of income, either for a term or for life. And it really can be beneficial for folks who think they have a lot of longevity. So let's say they're in good health and they think that they may have a long retirement and maybe are worried about running out of money. If there's any worry about running out of money, I would say definitely speak with a financial advisor. And yes, I think you're on the right track. And income annuity might be the way to go. And it would be a portion of their portfolio. It wouldn't be their whole portfolio, but maybe 10, 15, 20% of their portfolio might be dedicated to buying an annuity. And the beauty of that, again, is that it is a guarantee that you will never run out of money. The downside of an annuity is that it may not be a return that is as high as you could get investing on your own. But for a lot of people who are retired, that safety, that security, knowing that they're going to have that income coming in month after month, that's really more important to them than getting a higher return. So it's all about your stage in life and what you're trying to accomplish. For most retirees, they definitely want their money to grow, but they're really more worried about losing money than they are about earning money. So protecting what you have becomes very, very important. And an annuity is just one kind of tool that might be an option for them. There are many different types of annuities, and they can be a little complicated. So working with an advisor and kind of comparing different options, I think would be a really wise thing to do.
Okay, thank you.
Yeah. Any other questions? We've got plenty of time left. If anybody has a question, you want to come off camera or off mic and on your mic and or on the camera, feel free. I'm here really, as long as you guys want to be, definitely until the bottom of the hour.
Sorry, Laura. I know you answered my last question of that part, but I guess the part of the my question that we're struggling with is that should she do a rollover at this stage in her life?
Yeah, so basically the rollover is just going to move the funds from that workplace plan to an IRA. And so
Mm,
that there's no risk there. There's no
okay.
risk in doing that at all. Basically, that will just give more control. And so yes, I would definitely recommend moving it into your own IRA. That's there's no downside there, and it really will mean that your parents have more control over it. If they work with a financial advisor, that's probably the first thing that they would have them do is just go ahead and roll over all of those funds. So you have one sort of central location, one account to manage. Having it in a 401k is fine, but it just doesn't give you as much control. When you're ready to begin taking withdrawals, having an IRA is just a much easier account to manage. And they're doing that rollover is tax free. It's something that can be easily done. Just contacting the custodian of that account. They'll want to open an IRA first and then transfer the funds, have the 401k custodian roll those funds directly into the IRA. So that's an easy thing to do. It happens every day. So don't have any hesitation about doing that.
Okay. What about the conversion part into a Roth? Does that make
Yeah,
sense?
it may. Now,
Okay.
it may make sense if they have savings to pay the taxes, right?
Okay.
So this is what happens is when you convert from a traditional to a Roth, you incur a tax bill. So all of the deferred funds that are there, they're still waiting. They need, taxes must be paid on those. So when you roll them over into a Roth IRA, that triggers a tax bill. So generally, what people will do a little bit at a time, maybe you convert, a small portion each year, as you mentioned, just trying to get in that low tax bracket, not kind of triggering a higher tax bracket. However, how are those taxes going to be paid? So if they have savings to that they can afford to pay those taxes, that's great. But if they would have to actually take money out of the account to pay the taxes, that's when you may want to really think twice about it, because you don't want to pay tax and then pay tax on the tax. Do you know what I
Mm,
mean? It's
yes.
like um, you're if you don't have funds that have already been taxed in a savings account or a brokerage account ready to pay the tax, then you get into kind of a cash crunch. And I would hate for them to feel that. So just thinking about where are these taxes, where's this going to come from? And if they do have the savings, then as you mentioned, just doing a little bit at a time is a really good strategy.
Okay. Thank you for that clarification.
Yeah. What else? Anything else?
I have a question about,
Yes.
if that's okay, my second question.
Yes.
So I have my investments split up across different, I guess, services. So like Fidelity, I have like traditional IRA and Roth IRA. And then I opened up a brokerage account with Vanguard. And then I have a 401k from my previous employer with T. Rowe Price. And now I started a new job, and that's going to be a whole new 401k account. So I'm like, what should I do?
Yeah, yeah. So what I would recommend, Marcella, is rolling over your old 401k into your new. So assuming that's the traditional 401k, or maybe you've got a little traditional and Roth, you can roll those over right into your IRAs. And that's going to simplify things a lot. And yeah, just having everything at least under one investing platform will help with, paperwork and documents and all of that stuff. So that's one thing that you can do to kind of clean it up. You're going to have multiple accounts though, since you've got the 401k with the new job. So that would be one thing you could do, is just go ahead and roll over. And again, it's as easy as contacting that custodian, letting them know, okay, here's the IRA that I want to do the rollover, and letting them do it directly. That's called a trustee to trustee transfer. And I recommend that because there's no way you can mess that up. If they send the money to you directly, there's an opportunity for it to not get done in time. The rollover has to be done within 60 days, otherwise it becomes taxable. So do a trustee to trustee, a direct rollover, and that will just simplify things. And at least that's one less account you'll have, right?
Yeah, so I was just taking notes. So you said the traditional and Roth from
So
Fidelity to
so do
all
you have both in your old 401k, or is it all
of,
traditional?
yeah, I have both, I think.
So,
Um,
and a lot of people do, and that's fine. So the traditional portion of your old 401k would go to your traditional IRA. The Roth portion would go to your Roth IRA. So that it's like to like, the traditional to the traditional, the Roth to the Roth. That way you don't trigger any taxes. There's no penalties. There's nothing there. The problem is if you try to transfer traditional, like we were talking with Alana, traditional money to the Roth, that's when